early on, it's very important to try and be creative and thoughtful about how you finance. And one of the things that the strategies that I took early on is because we had so much conviction in terms of long-term value about what we could create. And this, I think, like safe notes in particular is a certain mechanism of financing that was originally started by Y Combinator and proliferated throughout. It was, how do we say, much more niche and much smaller scale there too. Like people would do like $10,000 safe notes, $50,000 safe notes, maybe $100,000 safe notes. The reason for these notes, instead of operating off of traditional equity financings where people give you a certain amount of money for a certain percentage of the company, was basically you would be able to, in exchange for either getting a higher valuation cap or getting a discount off of a future round, be able to effectively push out when that mark to market is on valuation. And from a discounting perspective, even if you basically are saying, X investor, I guarantee you will get a 30% return by giving you a 30% discount or plus or minus, or whatever it may be. Which, by the way, is like for most investors, like, those kinds of returns are like really good. Like, but if you think that you're going to like 10x and like grow by like 1,000%, like 30% is like completely in the noise. So, that's where you can be creative around these things. And so we took a mechanism that, normally people raise like 100K on. And over the years, we raised $200 million on safe notes, which I think
I've never heard that. That is obscenely extreme data point, everybody. So, but it's an example of your entrepreneurial thinking. Yeah.
So technically speaking, we actually, before going public, only ever did one equity financing because all the notes sort of converged together.
And in that first year when you're just starting, when the money's the most difficult to raise, how much of it was funded by the Hacker House?
I mean, most of it.
So that's what people have said. So when did you get your first outside check outside of? So you guys understand the Hacker House, he rented a big house, he subleased the rooms, and he made a margin off of that. And you also created this community that was also a competitive advantage.
Absolutely.
Yeah.
Yeah, it turns out the ultimate form of due diligence on people is living with them.
So you ended up getting your cash from the Hacker House, talent, and also tech development.
Absolutely.
Okay.
Yeah, no, and people, it like actually got to a point where people were like so excited to live with it, like literally like the market rate for what people were bidding on for like a closet, which it was around like $2,500 per month, like for literally like a closet in the Hacker. Like it was crazy, like, in terms of people were coming up with creative ideas for how can we just people want to be a part of the community, like, and it was just wild to see, early on, just how much of, well, like literally Wild West type mentality was it, but there was a lot of civility there to it at the same time. It's not like the movies in that sense.
But that was your cash for the first how many months? Like, was that for the first like?
It was the first year or two,
and then you got your outside capital
years.
from. On safes. Okay.
Yeah, and then started to get outside capital and safe, started compiling that on. And I think, as you progress yourself, you can mark up the valuation caps. You can, you don't have to give people as big a discounts. You can do other things, but it makes a difference. But the point is that, like, even by shifting out dilution like a year or two on things, that literally can make all the difference. I mean, you guys are familiar with exponential scales on things. If you like even slight changes in terms of the timing of when that dilution happens just makes like dramatic differences in the total outcome of what can happen from a ownership stake perspective. Like, to the point is that the reality is that most of the time, I mean, to end up with like a 5% stake, for example, by the time you go public, I mean, people end up diluting themselves like 20 times over. I mean, it's actually a lot of new shares that you just have to constantly issue. And that can be very challenging. So the key thing, though, is that it's not just about, and this is a very, very important point, it's not just about the owner, like, for example, as an entrepreneur, it's not just about the ownership stake that you have, it's about all the other employees that you have. You dilute, like, yes, you get diluted on something, but like if you bring more shares in, you do more financing, more dilution, then it dilutes everybody else along with you. So, what you want is to be able to end up in a virtuous cycle of value growth with your employees rather than a vicious cycle of value growth where then you have to issue more shares to then make up for that value.